Right now, the euro is sitting at one of the most deceptive price points we have seen this quarter. The daily chart is still technically in an uptrend, but intraday flows are screaming something completely different. This is exactly the divergence that traps retail traders and fuels institutional breakouts. If you are holding a long position right here expecting immediate upside, you are walking into a danger zone that smart money has been building for 48 hours. There is one trapdoor level that, if broken, will validate a massive liquidity grab to the downside, and one hidden opportunity that few are watching. I'll show you both, and then I am going to give you 3 exact entry and exit levels you can use to navigate this session. Let's get straight to the instant market verdict. The session bias is a cautious fade with a bearish lean on the active trading hours, but we remain inside a longer-term range boundary. This is not a trending environment. This is a range-bound grinding market where fading the extremes is the only statistical edge. The structural invalidation level that proves this bearish bias completely wrong is 1.1842. Write this number down. If the market manages a decisive 4-hour candle close above 1.1842, the entire bearish thesis collapses and we must flip aggressively long targeting the 1.2000 barrier. But as long as we are below that, every bounce is suspect. Let's deep dive into the technicals to understand why this level is such a brick wall. Starting with the top timeframes, the daily chart remains in a macro bull trend, but momentum is stalling. The 20-day moving average is flattening out near the 1.1800 handle, no longer providing a steep slope of support. The 60-day moving average is still healthy around the 1.1650 zone, which tells us the long-term picture is not broken, it's just tired. Now, drop down to the 4-hour chart, and here is where the seller's argument intensifies. We have a classic negative divergence. Price carved a slightly higher high near 1.1817, but the MACD histogram printed a significantly lower high. Buyers are exhausted. They are running on fumes. The 200-period moving average on the 4-hour is acting like a brick wall, perfectly aligned with that 1.1817 resistance we have mapped out. On the 60-minute chart, the asset is even more vulnerable. We are trading at 1.1734, cleanly below the 20 and 60-period moving averages, which are now curling down and acting as dynamic resistance. This is a momentum shift right before the US session. The critical support floor here is a band between 1.1729 and 1.1710. A breakdown below 1.1710 would be a structural fracture, triggering stop losses from late-day longs and opening the door to an air pocket down to the daily moving average support. While explaining this, we must weave in the cross-asset narrative because the euro is not just trading against the dollar, it's a battlefield of bond spreads. Look at the euro to pound sterling cross. We are seeing a fracture there, with the pound outperforming slightly on hawkish Bank of England repricing. That relative weakness in euro to pound sterling is spilling over into euro to US dollar, acting as a drag anchor. The dollar killer's dynamic between the euro and the cable is splitting. Right now, the pound is doing more of the killing, leaving the euro exposed to a stronger dollar index push. If the dollar index breaks above its own compression level, the euro is the path of least resistance to the downside. Now, let's bridge this technical picture with the fundamental driver and the cross-linkage. The core narrative over the last 24 hours is a shift away from pure ECB hawkishness toward geopolitical anxiety. The specific news flow regarding Middle East tensions and caution around the China outlook has introduced a safety bid, but not into the euro, into the US dollar. The equity market sees a risk-off grind, and while the euro used to benefit from hawkish policy, it is now losing its luster as a risk barometer. The institutional positioning suggests fading the euro is becoming a crowded short in the active session. It's the yield differential versus the safe haven flows that matters. For the next 1 to 2 weeks, my directional lean is a test lower toward that 1.1650 support zone unless we see a definitive break in the euro to US dollar correlation with risk assets. The exact event that would invalidate this entire bearish lean is a daily closeback above 1.1842. Which would signal that the 4-hour divergence failed to resolve lower and the bull trend is reloading. Most people will click away right here, but I am telling you, this next segment is where money is actually made. Keep watching if you want the exact plan. Let's detail the 3 strategies. Strategy 1 I call the sniper. This is the conservative approach designed for high probability. Your trigger condition is a failed bounce and break. Specifically, wait for a 15-minute close below 1.1710 with expanding volume. Do not preempt the break. Confirmation is king here. The logic for the stop loss is structural. Place your stop at 1.1750, which is above the most recent intraday swing high and above the psychological safety valve. This gives the trade room to breathe but strictly defines failure. If price reclaims that zone, the breakdown trap has snapped shut. Your target 1 is 1.1650, which aligns with the daily moving average support and historical congestion. Your target 2 is a deeper extension at 1.1610, capturing the liquidity void below. This gives you a risk-reward profile of nearly 1 to 3, a clean, bank-level setup. The setup is void if we don't get the volume spike on the break or if the break occurs during a low liquidity rollover. Our strategy 2 is the active trader, the standard momentum fade. Your entry condition is a pullback to the mean after the bearish structure has been confirmed. If we see price fail to reclaim the 60-period moving average on the 15-minute chart, near the 1.1760 resistance, that is your trigger. You sell the retest of 1.1760. The stop-loss placement reasoning is specific. Place it at 1.1790, just above the 4-hour moving average resistance. This is scientifically placed behind the point where sellers would logically capitulate. Once target 1 at 1.1720 is hit, you move your stop-loss to break even and then apply a trailing stop of 20 pips. Target 2 sits at 1.1685. This allows you to capture the acceleration without giving back unrealized gains if the buyers suddenly step in. Here is the interaction cliff. Let's see how aligned our analysis really is. I want you to type your euro to US dollar range for tomorrow in the comment section right now. Give me the high and the low. Let's map the consensus. I am reading every single one to see who has the puzzle solved. Strategy 3 is the aggressor, for those who understand high velocity and high risk. This is a momentum chase entry on a 5-minute extreme. If we get a massive spike down through 1.1710, wait exactly 5 minutes for the retest of 1.1710 as new resistance. If it holds as resistance, enter short at that retest. The stop loss is brutally tight at 1.1725. This relies on the theory that once support breaks, it becomes intractable resistance instantly. Your target is a bloodfast drop to 1.1600. This is only for those who know how to lose small and manage risk aggressively. If the spread widens or price snaps back, you are out instantly, no questions asked. Now for the risk management pulse, which must never be skipped. Of your capital per trade, do not hold positions through unscheduled high-impact geopolitical headlines, and your stop losses are completely non-negotiable. Let's close out with a retention loop and summarize the one most critical level. I want you to walk away looking at 1.1710. That is the pin in the hand grenade. Teasing tomorrow's focus, we are watching the US dollar index at a key gamma strike, and that volatility will directly translate into the next euro to US dollar impulse leg. If you want the full breakdown that bridges the dollar index with the S&P 500 divergence, that video is live on the channel right now. Check the end screen to clone my institutional macro map across equities. Smash the like button if this analysis gave you a clear plan. Subscribe and ring the bell for daily coverage. Remember, the market never rings a bell at the top or bottom, so you rely on Alpha Market Meridian. I'll see you in the next session.